What's going on, everybody? It's Trader Mercury here, back with another video. And today we're going to be talking about different kinds of patterns that you can actually trade in real time to help you with your trading system. So stick around to the end of the video where we approach the actual market and get rid of these squiggles and drawings and see how we could have approached this in real time. If you enjoyed this video, make sure you like, comment, and subscribe. We will be giving away a free spot to our insiders group that is already free. So if you don't win that giveaway, and you can comment your Telegram username below to win the giveaway. But if you don't win the giveaway, then no fear. All you have to do is sign up through one of our referral links, and the link is in the description below. It's 100% free. You just sign up through a referral link and you get access to 24/7 market analysis and constant updates, trade setups, order flow updates, tons of educational content, tons of live streams. So with all that out of the way, let's actually dive into some pattern trading. So first off, we're just going to talk about different kinds of triangles, and it's fairly simple. You've probably seen this before. Let's actually come over here and discuss the symmetrical triangle, or some people call it a consolidation triangle. If you refer back to that market structure video, you'll know that this is a consolidation market structure, right? We're creating lower highs and higher lows, simply just implying that whichever way this breaks is going to determine the new trend, right? So the way that we kind of think of this triangle is it's kind of just 50-50, right? And it's not always going to be 50-50. Is anything in life ever 50-50 other than flipping a coin, right? But we kind of want to see it as 50-50. It's not saying that we're bullish and expecting uptrend. It's not saying that we're bearish and expecting downtrend. It's just kind of, we're just neutral, right? And so whatever happens next as a result of this triangle, we want to pay attention. So then we come over here to the actual bias sort of triangles, right? And these are seen as continuation patterns. And that's important because continuation patterns are going to be a higher hit rate sort of trading style than something like a reversal pattern, right? So continuation patterns. So over here we have a descending triangle, simply just meaning that we're finding lower highs and for the most part pretty equal lows, right? Every single time buyers are stepping in at the exact same region, whereas sellers are getting more and more aggressive. So eventually this is implying that sellers are going to climax their aggression and buyers are going to get eventually exhausted and let price fall lower, right? So that's really all that it is. It's very, very simple, and you're just kind of assuming that this downtrending sort of structure continues, a very likely outcome, right? So then we take it to the flip side and it's the exact same concept. An ascending triangle just kind of implies that we're creating these equal highs and higher lows, meaning buyers are stepping in sooner on each dip, right? They're eager, they want to own whatever that asset is, and sellers are just selling the exact same region, hoping and praying that it eventually, breaks down. But this is implying that it's more likely for buyers to reach a sort of climax, eventually break out above this region, and sellers become exhausted, therefore seeing a breakout upwards. So these are our most basic sort of pattern tradings, and this is the continuation, right? Other than, of course, this symmetrical triangle, which is we just want to respect whatever happens as a result of this new trend. So then we'll go ahead and transition into reversal patterns. All right, so now we're transitioning into these reversal patterns. And before we do dive into this, I want to reiterate, these are seen as less probable, right? Because we're actually trading against the trend. So this is the part where people tend to get a little bit confused. And to make things a little bit clearer, we're going to apply a real world situation to kind of understand this a little bit better, because technically speaking, this is an uptrending structure, right? So this pattern, which is called a rising wedge, is actually implying that we're going to do the exact opposite of what our market structure is telling us that we're going to do, right? It's saying that we're going to reverse break down into lower highs and lower lows. So it's not typically your first go-to, it's not ideal, but it is still very, very valid. And it's the exact same sort of gist over here as well, where we're creating lower highs and lower lows, and our trend trading, all of our moving averages, our market structure analysis is all telling us that we are going to go lower. We need to respect the trend. And meanwhile, this descending wedge, right, or falling wedge as some people like to call it, is actually implying that there's a shortage of supply and newfound demand, and we're gonna reverse and price is gonna go up. So to kind of think of this and put this in a real world perspective, let's think of kids on a playground. So let's just fantasize this concept of little Timmy on his playground with 3 of his friends, and little Timmy is selling ice cream bars. So little Timmy is selling ice cream bars, and all 3 of his friends want one, but he only has 2 ice cream bars to sell. So as they're doing this sort of bidding to see who's gonna get this ice cream bar, price is going up, right? Because Savannah is willing to bid $3 for that ice cream bar, and then you have little Johnny who's willing to bid $4. And to those kids at that very moment on that playground, those seem to be the last ice cream bars on earth, right? That's how they're perceiving it. They're kids. They don't know any better. And all of a sudden, when they get to a peak point, someone is going to be left without an ice cream bar. They're going to get priced out. Someone's going to just bid such an absurd amount. And eventually, an ice cream truck is going to roll around the corner. So what happens when you have a supply of 2 and a demand of 3, and all of a sudden the supply jumps up to basically infinite because now you have an ice cream truck, and all of a sudden those kids, right, Savannah and Johnny, who ended up paying $7 or $8 for that ice cream bar, seem really, really stupid because now all of a sudden Zachary can go and buy an ice cream bar from the ice cream truck for $1. So that's how we're kind of seeing this, and to portray that exact same sort of kiddish, childish concept, you would want to see volume decreasing as price is increasing, meaning there's a volume sort of divergence. And truthfully, for every single one of these patterns, there is a way to pair volume along with them to kind of give them a more valid sort of style analysis. If you ask some TA traders, they'll tell you that your pattern is not even valid at all unless volume agrees with it. I tend to agree, but just to lay down the basic fundamental concepts, we're not going to dive into volume just yet, but typically just keep in mind for something like a reversal pattern, right, you want to see volume decreasing. So if price is going up, you would think volume is decreasing. That is agreeing with this reversal, right, with our rising wedge. And if price is going down, you would also want to see price decreasing, and that also agreeing with this descending wedge, this reversal pattern. It's the exact same concept for both sides. The only thing that would be really different, you'd have to find some other sort of kiddish analogy, and I can't think of one off the top of my head, but more or less exact same concept, right? If price is falling at rapid rates, it's coming to this climax, and all of a sudden, right, volume's going down, and all of a sudden we just have a demand spike, or let's say a supply shortage, and now we climax and we reverse in the opposite direction. In this case it would be up, and seller interest is actually decreasing as we're going down. So this is for the basics. We're going to lay that down, and then we'll go jump into some actual price action trading. So let's go do that. All right, so here we are looking at some Bitcoin price action on the hourly time frame. We just kind of time skipped all the way back to November, December of 2020. And here we have a consolidation triangle. right? So this is the one that doesn't really imply any sort of bias. It's mostly just neutral. We're creating lower highs, and meanwhile, we're also creating higher lows, right? So you can see how price mostly is kind of just going sideways, right? More or less. And eventually we decide we're going to break down from this triangle, right? We're portraying it with these random red trend lines, this pattern, that sort of concept idea. We've expanded away from that pattern and concept and idea. And here we even retest it, which is an ideal sort of situation. And we expand below, right? So in this sort of sense, our symmetrical triangle and our market structure analysis both would have been telling us to kind of take a short here. For these symmetrical triangles, you can try to guess which way price is going to break out, either 50-50, right? So it's not really too bad of a probability, but it is more appealing to get in after the breakout, in my personal opinion. So let's say we enter somewhere around this region as we're breaking down. We typically would want to hide our stop loss above, in this case, the most recent high. And let's just pretend we target somewhere over here, right? So we have a 2R trade, and that's pretty solid for an intraday scalp on the hourly time frame. So now we're going to go into our first continuation pattern, and we're on the daily time frame for Bitcoin. And this is more of a general sort of idea of what a descending triangle should look like. So keep in mind, we are on the daily. So for this top, these lower highs, I have used a red trend line, but for this bottom, I've more or less just used a gray box for the reason that we're not trying to be exactly pinpoint, right? We're more so just kind of trying to say, like, somewhere in this region we're continuing to find equal lows, meaning like maybe if we end up closing a daily candle below this zone, then we'll start to break down and see this descending triangle go into full effect. So since this is more of a drastic sort of high time frame idea of our triangle trading, then you'd probably make it a point to get in on one of these lower highs, right? So on one of these pushes upwards. So if you've identified this as a descending triangle, you would come in and put in some sort of short order, probably hide your stop loss above the previous high within this descending triangle, and then look for the breakdown to occur, right? I can't really see any way that you would have done too well waiting for the descending triangle to break down and then retest, ideal sort of everything is textbook situation. It's not always textbook. So in this case, you probably would have only benefited from your triangle trading sort of analysis if you anticipated it to occur beforehand. All right, so now we've transitioned over to Ethereum, and we're on the 4-hour chart, and relatively speaking, we're kind of just finding these equal highs into resistance and higher lows, right? So this fits our ascending triangle. It is, implying that sellers are likely to be exhausted eventually, and we're going to have some sort of breakout that leads to an expansive sort of move. So this sort of case, you could have looked to trade the breakout and then retest, right? That is the ideal, situation. Maybe something like this would have been more ideal before liftoff, but this isn't too bad either. If you're real patient, waited 3 or 4 days, you may have gotten an entry, assuming that you had some confluence to this idea that we were going to break out in the first place, or you could have looked to position yourself prior, ahead of time, hide your stop loss below one of the prior higher lows, and then look for the breakout to occur, right? Kind of just anticipating it. So that's going to wrap it up for our continuation patterns. Now let's go ahead and dive into those reversal patterns. All right, so now we're over here, we're talking about these reversal patterns, and we're looking at what is a rising wedge. So volume doesn't actually agree here. It is not a confluence in sort of analysis, so I'm not going to show it, but just know you do typically want volume to agree with you, meaning volume should be going down. It was, I'm not showing it obviously, but it didn't really fit the whole picture. So we're kind of just focusing on the pattern at face value for now, and we'll talk about volume and those sort of key indicators to give us more of an edge later down the line. But more or less, we are creating higher highs and higher lows. So at face value, you could also come in here and tell me this is a bullish market structure and we're on the 15-minute time frame, right? So it doesn't really mean much, but we are uptrending on the 15-minute time frame. And after this, what most Bitcoin traders would call a scam wick, we do eventually find our way below this sort of rising wedge. We are breaking the structure at that point, and we do eventually expand downwards. So the way that you could have traded this is by looking for some sort of short setup. After all is said and done, we break down from the trend. You know, we're somewhere over here, and you come in, probably hide your stop loss above one of these highs. All right, since we're on a 15-minute time frame, we'll probably keep the stop loss a little bit tighter, and then just look for a quick expansive move intraday. Just get in, get out, you know, real quick profits, sort of scalp trade, you know, nothing too fancy. But really good portrayal of what a reversal sort of rising wedge would look like. Our last example, our falling wedge. Let's not BS anybody. It's not always going to be fantasy and money coming in, you know, printer go burr. It's not always going to be like that. So I'm actually giving you an example where our descending wedge happened and we got our reversal, but truthfully, I think you would have been stopped out on this trade just taking pattern trader, you know, trading sort of strategy at face value. No sort of confluence, no reason to expect breakout, just looking at the way that we have discussed pattern trading in this video, and that is it, and then looking to go and apply it to real world trading. So in this actual scenario, I didn't check the volume beforehand, but regardless, the at face value descending or falling wedge is telling us we should be expecting price to sort of climax and eventually reverse upwards, right? And so in hindsight, we have done that. We did see an expansive move. The way that I was kind of teaching you to trade these patterns in this video is look for this breakout, look for the retest. That's actually an ideal sort of entry. And then truthfully, I can't BS you. I'm not here to sell you a dream. I would have hit my stop loss below this low, right? Because I'm fully expecting an expansive move upwards. So keep in mind, this is the 15-minute time frame. So on this trade, if we're just approaching the exact same way that we're teaching in these videos, even though it worked out in theory, it probably would not have worked out in practice unless you had some sort of confluence idea or a better reason for your invalidation, or if you could have justified an entry prior to this breakout, you know, things like that. So your setup would have looked something like this. And by all means, this doesn't mean that the setup is any more or less valid than prior to you getting stopped out. It just means that you took a probabilistic bet and it didn't really work out in your favor. So you're probably, and this is a quick side note, you're probably more susceptible to price action like this coming down, wicking you out of your trade at what is a local bottom in this case, and then reversing and playing out with your theory. So these patterns and these trading styles that we're separating in these individual videos are pretty valuable, but they're not really amazing in practice until you start to put it all together. So hopefully these videos are helping you guys kind of find your own system, your own way, your own feel for the market, your own approach, and helping you just get more comfortable. I hope you enjoyed today's video. That's going to be it for me today, and expect another video coming next week. Thank you so much. Do not forget to like, comment, and subscribe, and I'll see you